So I'll be honest with you guys, okay? The first time I started learning about investing, I kind of felt stupid. And I kind of felt like all this stuff is so tricky to understand the value of investing. And every single person I saw on YouTube breaking it down, they look a lot smarter than I am. However, though, when I learned about this investor, his name is Peter Lynch, he kind of broke things down in a way that made a lot of sense to me. And in today's video, I'm going to teach you what I learned from him when it comes to valuing a business. So this way, you don't think that it's all about being very smart with math or having this extracurricular activity going on in your mind that makes you such a good investor. The answer is no. Because when it comes to investing and being a good investor, it comes down to three things. It comes down to art, science, and also legwork. And let me explain right now, okay? If it was all about just the science of things, the balance sheet, the cash flow statements, basically the financial statements, then obviously the people with all the money would be mathematicians and accountants, okay? However, they're not, because the average accountant makes around $60K per year, and they're not the wealthiest bunch overall. However, if it was all about art, then all the speculators would make a lot of money, saying, hey, I believe that this company is looking so good. I like the products. Everything's gonna be fine. But then the average investor is losing money, and the ones that do make money make around 2%. So in reality, that's not it. Speculators tend to lose a lot of money. Now, third, legwork. What's legwork? Legwork is the person that's willing to do a lot of work to achieve their goals. But if you don't have the art part in it, you don't have the science part in it, it doesn't matter because, for example, day traders, they're the hardest working people in Wall Street, but then they still lose money. Around 80% of them lose money, and then the other bunch basically just break even. And the ones that really make a lot of money, they make money by teaching you about day trading. It's so hilarious to me, okay? It makes absolutely no sense. But in this video, my goal is to help you with the art, with the science, and also the legwork, because it requires all of those things in synchrony to make you a good investor. And to me, that makes things feel a lot better. Now, as always, guys, like this video, on top of that, also subscribe, hit the bell so you're notified, and I promise you one thing. You will leave this video telling me, Tommy, I feel like all of this is common sense, and that's what I want, because I want to break this stuff down in a way that it just makes sense. I don't want to complicate it using formulas or any of that stuff. I want to make it make sense, okay? Now, the very first form of valuing a stock is going to be approaching it as if you were valuing a property. Tell me, what do you mean here, okay? What I mean is, whenever an appraiser comes to your house and they're looking over it, okay, you got 3 bedrooms here, 2 bathrooms, the kitchen is nice, the bathroom is nice. You know, what they're really doing is making sure they have a good assessment of your property, and then they compare that to what another house with those similar characteristics basically sold for in your neighborhood. So if I know I have the same house basically as my neighbor Todd, and he sold his for $500,000, and you want to offer me $100K, I'm like, get the heck out of here. I'm not selling for that much. However, if I'm a buyer, I know Ted sold his for $500K, and I'm willing to sell mine for $200K, I'm like, hey, there might be some built-in equity here, and this person doesn't know it, so I might want to buy because it's undervalued. So now, how do you use this information when it comes to valuing a stock? Well, it's pretty simple. You had, for example, back in the day, you had a company, okay? This company was called Sunbelt. Now, again, these companies are old companies, so don't go buying these companies now thinking, hey, Tommy just gave me a tip. The answer is no. I'm teaching you something. You're not going to make money off of me on this video, okay? But subscribe, because I have other videos that are going to definitely make you money. But overall, Sunbelt was a company that was basically involved in the landscaping business overall. Now, they were selling for around $5 per share, and they had around 6.2 million shares outstanding. Tommy, what are shares outstanding? That's the amount of shares that are basically in the market overall. They're basically issued out. The company, when it went public, it issued out shares to the market. People bought it, and now people are involved in the trade of selling and buying those same shares. So overall, they have 6.2 million shares outstanding, and they're selling for $5 per share. So what does that tell us, okay? If I multiply the price times the shares outstanding, that gives me a standard valuation of the company of around $31 million. That's how much it's selling for right now in the market, minus its debt, but this company per se didn't have any debt back then. Now, what were you getting for those $31 million, you get an operation with around 98 stores, okay? Which sounds pretty good, honestly, and they also had great sales. However, if you compare this number and this store of this magnitude, Sunbelt, compared to Callaway, which is basically another company in the same industry, well, Callaway was selling for $4 per share. But they had around 10 million shares outstanding, which basically means they had a valuation of around $40 million. Meaning, hey, so this company is selling for more than the other company with 98 stores. However, this store, well, Callaway, they only had around 13 stores. And although they were more productive and so on, guess what? Our company, Sunbelt, had around 5 times the sales and also 7 times the stores. What does that tell you? That if we're going based of comparison, our company should be selling for around 6 times more money than that company. So that would give us a valuation of, instead of 31, more like a lot more money. That's the idea. More like $30 per share. That's your idea. So you can always use comparisons to see exactly, hey, is this stock overvalued? Is it undervalued? What's going on in the industry? What's the management like? And so on. Now, I will say one thing, that using this entire strategy as being bulletproof, it is not. Because, for example, what if the other company is also overvalued? So you can't just use this strategy as to say, hey, I know this company's undervalued because this one is this price and it has this and that. No, it's just kind of like a measuring stick to see exactly some perspective on what's selling overall in the market. And back then, for example, Sunbelt had $2 per share, and on top of that, it had a book value around $7. So obviously, it was definitely undervalued, because we know for a fact if the company closed down today, we would get $7 per share, and it also had $2 in cash. I mean, those factors showed us that, hey, this company is definitely undervalued. But again, it's just one way to take a look at the value of a company. Now, the second way is going to be via growth versus PE ratio. Now, before you guys clock out and say, Tommy, now you're talking about growth and PE who? What's PE ratio? The answer is, okay, this is simple, it's not complicated, and I promise this is going to make sense for every single person watching this video right now. Now, the very first thing is, guys, okay, when it comes to growth, when you're looking for a company, you want a company with a lot of potential. This is obviously very important. Now, you have people that they want to invest their money into companies that are basically very stable, very big, but in order for them to make any money really, the company has to grow and expand like crazy. But is that going to happen if the company is already big and massive? So, for example, you had a company like Sears, and Sears back in the day, they were in around 90% of all the malls in America. So where was Sears gonna go to grow by 10, 20% on average every single year? It was going to be impossible. But then you also had a company like Walmart, which was in only, for example, like 20% of the neighborhoods overall in America. So then you had, for example, 80% more places where Walmart could basically expand. So why is growth so important? Because if a company is growing, well, obviously, so will their revenue, dependent, okay, on how efficiently they're growing the business. Because sometimes companies use a lot of debt or bank debt to borrow money to grow the business. But if they use, for example, a franchise model, or they grow a little slower, more conservatively, more responsibly, it can be very effective. Let's look at Subway, for example, okay? When Subway first started, they weren't all over the place, but they had a lot of potential for growth because they weren't all over the place. But now there's a Subway everywhere. So where is Subway growing to now? The answer is where? To your house? Okay, the answer is very hard, right? But growth is basically, when you look at growth, we're usually looking at by how much are the sales increasing every single year, okay? That's the growth we want to see. Exactly how many stores are in the plans for this company to basically open up and open up and open up, and how much money are the same stores basically making, okay? Are those sales improving or are they going down? We're looking growth as a whole. Now, what exactly is PE ratio, okay? P ratio is simple, okay? P in the PE ratio stands for price, and the E stands for earnings per share. Now, remember when I told you guys about the outstanding shares, how many shares are outstanding in the market right now that people are basically buying and selling with? The answer is we use that same number to figure out the earnings per share. So again, if we have a company, right, and this company is making, for example, let's say $100. Now, after you deduct all the expenses and everything else involved into this company, it leaves us with around $30 in net income, okay? Net income. Now, if this company has, for example, $30 in net income, okay, and there are, for example, just 10 shares outstanding, well, divided by 10, net income divided by outstanding shares, that gives us $3 per share. That basically means that every single share is earning $3 on it, okay? That's the simple idea of earnings per share. It's like right in the name, earnings per share. And the reason you don't want to use revenue, the $100, is because basically there are a bunch of expenses, so you want to get the net number, okay? Now, once you grab that number, okay, if you divide the price of the stock divided by the earnings per share, that's going to give you the PE ratio. This ratio is important because it tells you exactly how many years until this company can basically make your money back, okay? That's the idea. So if you have a company where the earnings are basically 3, but the price is, for example, 100, so if you divide 100 divided by 3, it gives it a P ratio of 33. In about 33 years, you'll make $100 back because times 3, it's about $100, okay? That's the idea. So usually, how do you use these numbers to figure out if the company is undervalued or overvalued? The idea is, a very simple common rule of thumb is, you want to buy a company where the growth is higher than its PE ratio. Whenever the PE ratio is higher than the growth, people are basically saying, hey, we believe in this company so much, it's going to grow so much, and we're willing to pay a lot more money for the growth of this company, even though the growth is not outperforming it, okay? So that's the idea. So if you have a company that has a PE ratio of 20 and the growth is like 40, you're like, okay, I'm willing to pay that potentially. But again, these are not exact rules. These are just potential indicators to help you find different companies, okay? That's the idea. So using growth and using the P ratio to find potentially undervalued companies. So whenever you see a company that has X P ratio and the growth is higher, it might be undervalued. Whenever you see a company that's basically the growth is X and the P ratio is higher, it might be overvalued. And whenever you see that the industry has a P ratio of 5 and that company has a P ratio of 49, it might be, hey, what's going on with this company? Okay, what's going on with this company? Okay, it's just a pointer to potentially give you a hint of what's going on with this company, but none of these rules should be used as saying, hey, the P ratio is this is this. All right, put all the money in there. Okay, that's not a good idea. And that's definitely not what you want to do. Now, the third way to value a company is going to be to use the discounted future cash flows. Now, this sounds complicated, but it's really not that complicated. It's basically what's going to be the value of the money I put into this company in the future in today's money. Now, overall, to make this even more simple, it's kind of like, for example, let's say if I was going to invest into Bob's company and I'm buying money, I'm spending money on Bob's company to buy his stock, but I want to figure out before I buy his stock exactly how much is my money going to be worth in the future if I put this money to work in Bob's company. Now, Bob tells me this fancy story. He tells me, Tommy, I'm bringing innovation to America. I'm bringing shoes. And I'm like, shoes don't exist, Bob. We are barefooted here. We don't use shoes. And he's like, well, I'm going to change that. Now he says, Tommy, for every $100 that's put into my company, after the cost to actually make the shoes, after the expenses to pay my employees, after the taxes and everything, you're left with around $30. So for every $100 employed, you get basically $30 back, okay? And that's basically the owner's earnings in a sense. So when you look at that, you have basically what we call, in a way, a return on capital of around 30%, which is actually pretty impressive. So when you see, okay, I'm going to make 30% by putting my money into Bob's company. Now, if I didn't put my money into Bob's company and I put this money, for example, into a bond that pays me 10% versus 30% here, which one exactly is going to be best, okay? That's the idea. You're always comparing, for example, what you can get in the risk-free area versus what you can actually get, for example, with Bob here. Now, the thing about Bob is that because he is in an industry where nobody is using it, and he's going to be brand new, the first one there, he's looking at 20% growth every single year in sales. So this money that's going to be employed, the sales will continue to grow and grow and grow. And if the company gets more efficient, potentially, we're also going to make even more money. And I should correct myself, because return on capital isn't really that simple. It's more like, for example, all the capital the company is basically employing, for example, from the equity, from the long-term debt, and then once you divide that number by basically its return or earnings on earnings for the owners, then you can kind of see exactly, well, here's the return on capital. So out of all the money that the company is basically using, here's how much is actually making us as investors overall. Now, over time, guys, I'm gonna be honest with you guys, okay? I don't have a built-in calculator. So the way that I would go ahead when it comes to predicting future cash flows and basically navigating towards what its present value is today is by simple, using a calculator. Now you can go on Google, just type in discount cash flow calculator. And for example, right here, let me zoom in all the way to give you this this figure a lot better. But overall, let me zoom in even more. But overall, as you can see here, if the expected annual growth of Bob's company is, for example, 20%, and the weighted average cost of capital is 30%, that basically means how much money as an investor am I expecting to make from Bob's company. Like, I want to have a return of 30%. Okay, that's the idea. That's how much this capital is going to cost this company to actually acquire it from me. Okay, because right now I can get 10% from a bond or whatever. Okay, so this number is how much money you as an investor want to get from the company. And then you say, hey, the years of cash flow include around $100. So every single year for the next 100 years, okay, until the company is basically dead, I'm gonna make $100 per year. And this, if this gives me a positive number, it tells me, hey, the money that I'm gonna employ in Bob's business is actually gonna return to me a positive number, okay, which is actually pretty good. Now, what that means is I'm simplifying it a lot. I am, but once you understand what you're doing here, it's kind of like saying, when you take into account what you can make from a bond, which is risk-free, also what inflation is going to eat up from your investment, and you take those numbers and then you basically say, hey, well, if I'm going to make overall like this much here and you're offering me this much, I want to make sure that the net present value of that money is actually worth to me more. To put it even more simple here, if I were to invest $6,000 into a machine that will produce for me $1,000, but over time I could have invested that money into a bond, and you also have inflation to worry about, well, what's going to be the present value of all that money that machine basically made me over that long period of time? Because although it might show, hey, you made $6,000 from your investment, well, if that money is only worth now like $4,000 in today's money, I could invest that money somewhere else to make me more money that will be worth more in today's money. That's the idea. It sounds complicated, but it's not once you really understand it. Okay, so what you want to do is you want to study discount future cash flows. And there's a lot of videos on YouTube on that. And if you want me to make a video on it, let me know in the comments down below. But overall, guys, those are different ways to go ahead and value a company. I wanted to make this video very simple because I want to make sure everyone understood it, okay? So first, you have the comparisons, okay? You compare what one company is selling for versus what another company is selling for. And what does each company actually have? And what are you actually getting from those companies? Second, you have, for example, the P ratio, and you also have the growth. If a company is growing a lot, and they're doing it responsibly, and they're selling for below its growth, that's probably a good indicator that's probably undervalued. Then third, you have, if a company you can put money in today that's going to be worth more money in the future, that's also a good indicator that you also are making a good investment. That's the idea, and that's the overall video, guys. I hope this video makes sense. I hope you understand it. If you don't, comment down below, let me know, and let me know what you want me to do next, okay? But as always, if you made it all the way to this point in the video, I want you to comment down below Peter, because this video is heavily inspired by the book Beating the Streets by Peter Lynch. And this book right here, guys, and this book right here, guys, is an amazing read. Peter Lynch is definitely one of my favorite investors because the way he goes about breaking things down when it comes to investments is just very common sense like. And it's almost like too simple, but it's not that simple. But it makes sense once you get into it. But it's one of my favorite teachers for sure, guys, okay? And as always, like, subscribe, hit the bell to get notified. Comment down below any questions. Up here is another video. Over here is my face. Click subscribe. And as always, long-term team officially out. By the way, follow me on Instagram at TommyBryson.